Hi, welcome to this TMS tutorial video on comparing lender options using Tactical Mortgage Solutions. So showing you a bit of the benefit of comparing some options. So this is the scenario that we were discussing in the previous video in the series when we were going through a bit of a budget and monthly costs as well. So once you've gone through this stage, there's a couple of other features we won't be talking about today. But the one at the bottom here is mortgage product options. So this video will just talk through how you add these, the benefits, pros and cons, and a bit of a strategy and example of what you go through with clients. So once you've gone through this budget, let's say you're working on a pre-approval, the client has decided, okay, which scenario do I want to go for? I want to go for this scenario here with a mortgage of $798,000. Because they have 20% down payment, you can show them the different amortizations as well. So $798,000. So let's just add a couple of rate plans. So here you click add, and then you can add different mortgage components. So firstly, let's add a 5-year fixed with one of the monolines. Oh, sorry, with a credit union with First West. Let's go with, let's choose a variable, one of the banks. Let's say there's a shorter term fixed special for a 3-year as well. Add another one line here. Let's just say MCAP. Okay, so what we know is they're in the insurable category because they have 20% down payment, and the purchase price is under $1 million. So $798,000 is the mortgage amount. So let's put in 798. And for this, we're just going to enter some rates just so we can do a bit of a comparison and show you the tool. You'd obviously research these as well. So we can amortize up to 30 years. So you can discuss the pros and the cons of that, or you can compare side by side. So the first thing we do here is we've put the mortgage amount in. Let's just say, so the rates here are the same. But there's more information other than the rate, and we'll update the rates accordingly. So firstly here, you'll see there's the lender information. You have the details that it's fixed, what the compounding is, which can be really important as well. So for example, I'll tell you what, let's update this to be a variable with one of the banks. So let's just say RBC, just to show you, because I know their compounding is different. Where are they? There we go. Okay, so here we have a variable. You can see their compounding is monthly, and we'll come on to discuss the impact of that as well. These are all 5-year terms, so we can compare them all over 5 years. And first off, you can see, even though the rates are the same, the amortization is the same, the mortgage amount's the same, the payments here are actually different because of that monthly compounding. It does make an impact over the duration of the loan and for each monthly payment as well. You'll also see there's details in regards to the product information here as well. So if you ever struggle with remembering all the different product breakdowns, we have that information in here in regards to penalties, kind of how the details of the interest compounding and some information on the product, so you can actually show, beyond just the rate, here's some information. Okay, here are prepayment privileges. So you can see here RBC's prepayment privileges aren't as flexible as well. You can see in regards to flexibility and what the penalty is, bearing in mind the type of mortgage here as well. So you can see here that this is because this is a credit union. There's some somewhat flexible. We say lack of flexibility. It tends to be when it's a fixed rate at one of the banks, because the penalties, the IRDs can be higher. So this is somewhat flexible. It's less flexible than the variables, but because it's at a credit union, the penalties will be slightly less just due to the calculations. So you can start talking about some of the other features, portability as well. Okay, we want to make sure that the mortgage is portable if they wanted to move property, and keep the mortgage as well. And then the key thing you can show as well before we even start looking at rates is if we're comparing variables, you can actually show them, okay, well, in this scenario, if the rates are the same, let's look at how the amortization schedule here. Well, let's put in a prime rate forecast. So let's just put in the latest prime rate forecast that we have in here. Let's save that. And then we can really show them the difference of these products. So if you're competing against RBC, for example, you can show them, okay, well, with RBC's mortgage, as the rates change, you can see them coming down here, your payments actually stay the same. It's the amortization that changes. So, if a client wants payments that come down, if this is too high, they don't want their payments at the level of 5.95, let's say, and we're assuming the variable is just prime, we haven't put a discount in there. This may be too high for clients. Maybe they want a variable, like with Scotiabank, where the payments come down as the rates change. So you can see the payments are lower anyway because of the compounding, but these payments actually change and they come down over time as well throughout the term of the mortgage. So that's another feature as well when you're showing these rates side by side. So let's just say, so if we scroll down here, let's say that the fixed is as in today's time, is in late 2024. Let's just say we have a fixed, kind of around 4.25 for a 5-year. Let's say these are prime less. And again, this is just an approximate, and these change all the time. So we're just doing this to show you a bit of a comparison. And let's see here. Oh, it looks like that number didn't update correctly. Okay, the client's reached out. They've been offered prime less 5.5, and you've been offered prime less, not that much. We wish. 0.75. There we go. Okay. So what you can do, we have those forecasts in for where the prime rate's going to go, and this is where you can really go into really start helping clients by saying, okay, well, what does all this mean? Is this what's this going to mean for my back pocket? Which is the best option? So if you scroll down here, you can see a comparison of the different options. So we're looking at this. If we're comparing these two to the first option of the 5-year fixed here, you can actually see that even though this is lower right now, with that projection of where the rates will be, if this ends up in the 3.95 range over the next 5 years, there is a saving by choosing the variable of $7,000. So when we talk about, it's not just about the rate that you see. If you saw these two and you say, well, this is lower, the payments are lower, it's about the using those market projections as well to really advise clients. Let them make their own choice as well. You can show them this information, and then whether they decide on a fixed, on a variable, a shorter term fixed, is often what we're comparing these days with the 3-year, because it's not quite that 5 years and there's a bit more comparable. But you can show them, well, if you're considering that 5-year, even though that rate is lower, and these will be the lowest rates you'll see online, actually based on current market projections, choosing a variable with those projections actually would save you $7,000. Your monthly payments will be $4,000 lower, and your outstanding balance will be nearly $3,000 lower at the end of your term, totaling $7,000 here. So there's a real impact of choosing that. Then compared to the RBC option here as well, you can see there isn't as much of a difference because they are changing. Even though there's that difference in regards to the compounding here, to the rate, sorry, but you can see it's still beneficial. There's still a $1,000 benefit here from the RBC option as well. One of the reasons the RBC is closer than you'd probably expect in this instance is because the amortization is decreasing as well. So that helps reduce some of those interest costs, but you can see the monthly payments are significantly higher. So clients may not have the extra $34,000 that they want to pay during their term, or with this option, they have the choice of doing that. So they can pay their mortgage down quicker if they'd like, but it's up to them. Let's say we change the amortization for one of them to 30 years, and then let's see how this changes the numbers. So you can see it's still beneficial in regards to so the monthly payments are significantly lower. These are the outstanding balance will be higher, but because you're making that saving on the payments significantly, the total savings here are $4,500 as well. So it really shows the numbers of when you're doing that strategizing with clients. Depending on their needs, you can compare different lenders. Often this is great to do once you have a bit of information, once you've gone through the above, or you can just show, if a client wants to see an example of rates and things like that as well, or if you're competing against the rate from RBC, often what we'll do is we'll use this tool to say, okay, here is and we'll do a separate video on this. How do you compete against lenders at renewal? Okay, well, this is the lender's rate. These are some comparable rates. These are the pros and the cons. Talk about features other than just the rate. Talk about features such as, this is a VRM, this is an ARM. This means the payments stay the same even when the prime rate changes. The payments on this one change when the prime rate changes. That alone can win you deals. Some clients want their payments to come down with the variable rate changes. So us being able to have access to both of those types of products is really useful as well. TD, for example, they have the VRM as well. If the client wants that option, then you can present them side by side. You can also mention the compounding, so you can show them, when we're looking like for like. So if we just, so let's just get rid of the changes here, just so you can see, like for like, just if the mortgage rate stayed the same. So let's click save on that. Okay, let's change this to prime less 7.5 like the other one. Remove any of those projections. So if we scroll down and we're looking, of course these will be red compared to this, but you can see when we're comparing them side by side, you can see actually in regards to the interest. Okay, so this is over 30 years, so that's why it's changing. So over 25 years here, you can see there's about a $2,000 difference just because of the way that the interest compounds. Now that changes if there's drops in the prime rate, of course, and those calculations change. But you can show, that's a piece of information that lots of people probably don't even understand really what the compounding means, how that works, what impact there is of that. And by using this tool, we've actually realized that let's say RBC is offering a certain rate. Let's say you're higher, so you're only prime less 0.7. So let's scroll down and let's see if we're still beating the RBC rate. You're still beating the RBC rate, even though your rate is higher, because of how they compound their interest. You actually save money with a slightly higher rate because it's compounded semi-annually. So I think the difference is around so let's just do 0.68, and we should be close, around 0.07, 0.08, something like that in regards to the compounding. So okay, so there you can see RBC is now benefiting. But just by having those knowledge and some of those strategies, it kind of gets you thinking and really, shows the client all of the different features as well. It's really important to not just focus on the interest rate, but by using this tool, you are showing the interest rate, you're showing the actual cost, you're showing the actual difference in their payments, the difference in their balance at the end of the term, how comparable these are based on market projections as well. You can actually show them the numbers and what those projections are, rather than just saying this rate's lower, therefore it's better, because that's not always the case. You can see this is a lower rate, but actually it costs more money than a slightly higher rate. And also, what if the client moves? What if there's higher penalties, or what if the prepayment privileges are really important to them? So there's lots of different factors here. There's lots of different things you can do with this tool, especially in regards to if there's changes in the prime rate projected, and showing those numbers and really breaking down that information for clients. Not only does this help you really stand out amongst the banks, you're showing your value as a mortgage broker as in, I have access to different products, different types of mortgages, different types of rates. Here are the pros and cons of these. That's a huge value. But you can also, show that you can offer, additional services beyond, competitors as well. You're showing them options side by side. You're doing those calculations. You're talking about projections in the market, and all of that really helps cement your role as the expert and as someone that will be able to help and provide the best solution to those clients as well.